from stable, citing the prolonged impact of the COVID-19 health crisis. Fitch notes the revision reflects increasing risks to the credit profile from the pandemic's impact and its aftermath on policy making. A negative outlook means the Philippines now faces a potential credit rating downgrade, which could lead to higher interest on loans. The credit rater notes the pandemic has weakened the country's fiscal position, and it forecasts debt to GDP ratio to hit 52.7% this year. Fitch also expects a slower recovery for 2021. It now sees a full-year GDP growth of 5%. That's lower than its April forecast of 6.3%. This is also below the government's revised target of 6 to 7% for 2021. Now, it notes that this year's pace of recovery has been set back by new variants of COVID-19 as well as quarantine restrictions. The credit rater says the Philippines has been particularly hit by the pandemic, with the economy contracting by a record 9.6% last year. Now, on the brighter side of things, Fitch says, quote, green shoots of recovery are emerging on the back of the resilience of remittances and exports. The credit rater also retained the country's credit rating at BBB, that's a notch above minimum investment grade. Reacting to Fitch's latest action, Finance Chief Sonny Dominguez says the impact of the pandemic is only temporary. He says the economy is now en route to solid recovery path and is seen to have posted double-digit growth in the second quarter on the back of the vaccine rollout and economic recovery measures. Bangko Sentral Governor Ben Diokno also believes the pandemic-induced drag is just transitory. He recognizes downside risks to growth outlook, but says the country's solid fundamentals and reform initiatives will carry the Philippines towards a solid rebound. Now, NEDA stressed the need to fast-track the rollout of vaccines, especially in areas with high infection rates. This amid risks from relatively new and faster spreading COVID strains like the Delta variant. NEDA Secretary Carl Kendrick Chua said the government should focus on accelerating vaccine deployment as more supplies are bound to arrive starting next week. Chua added that new COVID variants should not be so threatening if the government improves health protocols and only imposes localized lockdowns on areas with high infections. Moody's Analytics added that the Delta variant poses new challenges to the already tough balancing act between keeping the virus in check and keeping the economy up and running. Now, in our interview on our show, Businessworld Live yesterday, senior economist for Asia Pacific, Katrina L., said an outbreak of the variant in densely populated areas like Manila can trigger further lockdowns, which could sink Philippine GDP even deeper. As it is, L said they do not expect the Philippines to return to pre-pandemic growth levels until the third quarter of 2022. She added this puts the Philippines as one of the clear laggards in Asia, since other economies are expected to return to pre-pandemic growth by the middle of this year. Now, like NEDA, AL said the country will keep underperforming if our vaccination program will not be accelerated. Okay, opening the markets here, of course, as a reaction to that whammy, so to speak, that came out just after 6:30 p.m. yesterday. That report made public by Fitch, that's down by 0.2%, now trading at 6897.10 in terms of our index. Take a peek on these sectors here very quickly. Everyone seems to be quite largely in the red. Actually, properties the hardest hit, that's down by 0.6%, but really it's a broad based sell-off in just the first 5 minutes of trade. Now, speaking of properties, I really had wanted to focus on that sector. Let me pull that out for you guys so you could see which are the movers and which ones are really dragging this index down. Now, this of course comes as it has already been in focus throughout the week. Yesterday we had reported that the PSE has approved the application of PhilInvest REIT Corp, that is going to be called PhilREIT, formerly a Cyberzone Properties. They have a portfolio of 17 office buildings. Now, they have announced that the books will be open from July 13, that's today, until July 19. Now, meanwhile, you've got Santa Lucia Land also trying to raise money they have filed a registration with the SEC. That was on Friday for a follow-on offering of up to 3 billion new shares. So that's 2.5 billion common shares plus an over allotment of 500,000 more, priced at up to 3 pesos and 29 centavos a piece. So if that does happen, that will be around 27% of Santa Lucia Land's outstanding capital stock, and they're going to be using those proceeds to partially fund capital expenditures. You could see only 3 players in the property index trading in the green this morning. Checking in on the biggest headlines, we're keeping our eyes on the Trade Department expects the number of MSMEs closing due to the pandemic to go down in the coming months. That is, if there would be no shift to stricter quarantine measures. Now, based on the latest survey, 10% of MSMEs remain closed as of June. Now, Trade Secretary Mon Lopez told the Philippine Star that this is already an improvement from the 16% of small businesses that shut down their operations in the month of May due to the pandemic. Now, recall that this came after Metro Manila was placed under ECQ in March due to a surge in coronavirus cases. To prevent this from happening again, Lopez reminded the public to continue observing minimum health protocols and get vaccinated. Meralco will procure nearly 4,000 megawatts of additional power supply in the next 2 years. That is to meet its projected demand growth until 2049. The power distributor is projecting peak demand to increase by 2.2% this year as some businesses have reopened. Moving forward, they expect demand to increase by an average 4.12% annually until 2030 as economic activity resumes. Now, to shift its energy mix, Meralco is also targeting to bid out up to 1,500 megawatts of renewable energy generation in the next 5 years. After a slew of fairly optimistic news, we get hit yet again by a downgraded outlook. Is this just a bump in the road or a major detour? Here to weigh in, we have ING senior economist NICKY MAPA. Good morning, Nicky, and welcome back.
Hi, good morning, and thanks for having me, Danny.
Okay, Nicky, downgraded outlook, not yet a downgraded credit rating, but nevertheless, was this anticipated? We've been through this before. This is not the first time we've had a negative outlook and then it reversed to stable. So is this something that you had anticipated, something that is worrisome for you, or something that is actually easy to reverse?
Yeah, well, this is something that we had sort of expected, however, not hoped for, given the fact that we remain in recession. We're 5 straight quarters of contraction. We will see some growth in the next few quarters, but largely due to base effects. On the whole, the entire economy doesn't seem to be moving as it used to. There's not a lot of momentum left in this economy. So this might be something we might have to contend with for the next few quarters. Possible downgrades on the outlook from other ratings agencies as well.
Okay, let's talk about that later on, the possibility that it might result in other downgrades. But what led to this, first of all? They're saying it's fiscal deficit. According to our, economic managers, we've been having fiscal discipline in order to avoid something like this. They've been saying time and again there is fiscal space. So what is going on here? And could this have been avoided in any way with more fiscal discipline?
Yeah, so the 3 major ratings agencies always peg these two factors for keeping us in good standing. The first is our above median growth trajectory. So amongst peers, we're rated as having one of the more promising growth outlooks. That it's robust, it's high, it's consistent. But for the past few quarters, we've not really been able to outperform the region. In fact, we lag the region, and that's something we might have to bear with for the next for some time now. With that in mind, if we're no longer seeing above median targeted growth, we're no longer standing out in the crowd. Secondly, our debt metrics continue to be quite worrisome. I think the most recent reading tags our debt to GDP ratio above 60%. Now, this 60% threshold is the magic number that the big 3 are watching. Anytime you have debt to GDP above that 60% threshold, that's cause of concern for these ratings agencies. And now that we have our debt to GDP ratio above 60, I think this was one reason for Fitch to give us like a warning, a slap on the wrist, and say if you don't reverse any of these trends, then we're likely to see a downgrade in the near term.
How likely is this downgrade? To what extent do we have time to actually reverse this trend? Secretary Dominguez has also already mentioned that this is a short-term thing; it's a temporary thing. The debt to GDP levels are not worrisome, but to what extent will you start being worried that this will actually result into more action, and not just for Fitch, but for the other credit rating agencies as well?
Yeah, so I think the two of the big three come and follow with regard to outlook revisions from stable to negative. At the same time, I think that what really needs fixing is our economic engines. Our GDP continues to be quite subdued, and this is because of a myriad of factors. You have the lockdowns, the partial lockdowns that are in place. You also have other factors like very, very poor consumer sentiment. The BSP came out with its recent survey of consumers showing that Filipino consumers are still very pessimistic about the growth rebound. Yes, it's improved from where we've come at the height of the pandemic. However, it's still nowhere close to pre-pandemic levels. So on the growth front, I'm not very optimistic for a quick rebound, and that's why I am very much concerned about this development. We could face a downgrade before the end of the year if growth continues to struggle and if our debt continues to pile up.
Secretary Dominguez said that they're expecting double-digit growth in the second quarter to actually come out, and this might be sustainable, especially if the vaccine story improves. Do you feel the same optimism in terms of double-digit growth having happened? Of course, low base year, but nevertheless.
Yeah, I think all analysts are pegging at least a double-digit expansion in the second quarter. But once again, as you mentioned, this is all just the base effects. After you fall by 17% in the second quarter of last year, it's very easy to post a double-digit gain on the back of that. So this is just a mirror image of the downturn that we saw last year. So I think posting that strong second quarter GDP number really doesn't give the full picture. If you look at quarter-on-quarter GDP growth, we're not likely to see a positive number in the second quarter. So I think if we want to look past the base effects, we have to look at how the economy is moving on a quarterly basis. And if you look at it from that view, it doesn't look quite promising.
Okay, they've also mentioned that the government's targets of vaccination are ambitious. Of course, they're mentioning the 70% by the end of 2021, and a lot of even the government themselves, a lot of people are saying, okay, let's target for 40%, which is a little bit more realistic. But to what extent can you actually say that the government's targets, especially when it comes to growth, are still achievable, especially since you've already got a slew of growth downgrades and they're still holding the fort at 6 to 7%. What is keeping them so optimistic that is not keeping others on the same boat?
Yeah, I think the authorities continue to believe that the economy as a whole, in terms of all of its fundamentals, are intact, and that the only thing holding back our growth story are these artificial restrictions, as Carl Chua calls them, these lockdowns. His theory is once you release us from lockdowns, we will revert to 2019 spending. We will revert to 2019 investment outlays. But for my shop, I don't see the Philippines moving like it used to. If we just look at the consumption levels, retail sales, at least taken from the consumer sentiment survey, it doesn't look anywhere close to how we've been performing prior to the pandemic. Even on outlays, if you look at investment outlays as measured by bank lending's in the red for 6 straight months, and it looks like it's going to stay there for quite some time until the base effects wear out by the end of the year. So there's not a lot of momentum. We are no longer the 2019 version of the Philippines that we were. So I think if we take it from that point of view, knowing that we're no longer that juggernaut of economic growth, that 6 to 7% is very ambitious. I mean, it's good to aspire for higher growth numbers, but given how I see the economy moving, it doesn't seem likely that we're going to hit that 6 to 7 growth target.
In terms of concrete impact of this outlook downgrade, is there a real impact? Because I mean, the rates are not necessarily going to go up yet unless we do have a credit downgrade specifically. But you did mention, the loans already it's still very, very low in terms of loan growth, and we do need to fund this ballooning, so to speak, fiscal deficit. Tell us, but is there going to be any change, any material change, given this outlook downgrade on the budget, on how we're going to finance this pandemic?
Yeah, that's a very good point. For that question, I want to point you to the article written by former Deputy Governor Diwa Gunigundo when asked if credit ratings can be, as they say in Filipino, nakakain ba yan? Or can you eat credit ratings? And his short answer quipped to that was, yes, you can eat credit ratings, in the sense that it leads to lower borrowing costs, and the savings on that interest, on the interest cost, goes a long way and can be utilized for other productive means. So credit rating downgrade, a full downgrade, will, as you said, result in higher borrowing costs, and that will sort of channel some money that we could have used for productive means, and simply paying off higher interest costs. So a downgrade at this point, at a time when we're going to have to borrow a substantially more money to fund all this debt and deficit, is going to be very costly in the near term.
Okay, so vicious cycle. Is there anything that the finance department could do better to avoid this situation, right? I mean, we have unspent funds from Bayanihan 2, to the tune of 63.5 billion unspent. So they do have this money. They do have the capacity. They've already, used the Bangko Central to do the heavy lifting when it comes to monetary policy. Well, what more can they do to avoid this going into a downgrade?
Yeah, as you said, there's money there. It's just not getting spent. So I think the strategy can get a bit of a tweak with regard to the priorities that the government has set forth. The strategy that's been employed so far has been to chug money, to throw money at in a sort of trickle down fashion. You want to put money in certain projects that will eventually trickle down to the real sector. I think right now, or which should have happened maybe last year, you should be throwing money directly at the real sector. Try to get the money that you have, limited as they are, directly to the real sector, to the pockets of people who can spend it right away, and to jumpstart economic growth. Plugging 40 billion in government banks does look good on paper, but it does very little to jumpstart real sector activity.
Okay, so let's be a little bit more rooted here in terms of spending. Finally, Nicky, before we let you go, let's talk about the weakness of the peso and how this all feeds in to this equation. Some analysts are saying that this might bode well when it comes to FDIs, and we do see, well, at least April surging when it comes to inflows. But how, to what extent is this okay to be breaching 50 when it comes to, inflation that might still have some upside risks due to the oil prices? And of course, consumers quite worried about this hurting their pockets.
Yeah, so two things there. First on how the weak peso and how that might affect the outlook. The BSP and the rest of the DBCC has a 49 to 53 peso assumption for the year. So I don't think it's raising any alarm bells just yet. However, as you did mention on the inflation side, that could kick up inflation a notch. Right now, the BSP's forecast at 4% at the top end of that 2 to 4% inflation target. So a weaker peso will make that very, very tenuous to hit that 4% mark. If we continue to see a weaker peso, that's really gonna push up imported inflation, as well as the dynamic of rising crude oil prices is really going to hit us hard. So the threat in the near term of a weaker peso is, of course, the threat on inflation, and we might miss target this year. However, on the flip side, you got good things happening as well. This will bloat these. Help increase the peso purchasing power of OFW remittances, which will go a long way to sort of delivering a nice shot in the arm for consumption here in the Philippines.
Okay, so some plus side there. So FDI's market impact and also the remittance is good for that. But in terms of the general economy and of course this downgraded outlook, it seems like we're walking on eggshells at the moment and really waiting on bated breath on how this is all going to be developing. Thank you so much for those insights, Nicky Mapa, Senior Economist, ING.
Take care, stay safe, bye.
And that's a first look into the business day. Today's Tuesday, July 13, 2021. Catch Business World Live for the market close. It's at 3:15 p.m. today. I'm Danny Laurel. Mask on, wash hands, stay safe, Philippines. We are One News.